Yeah. Well, look, it's nice to have so many investors of Agronomics on the call. Thank you for your support. Obviously, the share price performance has not been great over the past couple of years, but hopefully we've got some news flow which I'll tell you about that is going to change that. There's some very positive things happening within the portfolio. Given that so many of you are already invested, I think I might leave more time at the end for Q&A, but still do my best to get the people that aren't familiar with Agronomics up to speed. We are a London-listed investment company, and we are the only way that investors in public or private markets can gain access or get exposure, rather, to the field of cellular agriculture in a concentrated portfolio. We have raised £135 million to date. We have BlackRock, Canaccord, Allianz, Lombard Odier as a couple of our key institutional shareholders, as well as my co-founder, Jim Mellon, that owns 15% of the company. We have deployed the bulk of our capital, and at the moment we've got £11.4 million of cash left. But this gives us a sufficient runway for something in the order of 10 years, even more than that, actually. So we have the portfolio that you will see in the future, and plenty of runway in order to see that play out. And again, some very, very exciting opportunities within. Our portfolio plays to a number of major secular trends that aren't going to go away for decades, from food security through to sustainability. This opportunity is absolutely immense, and we believe that we are at the beginning of a multi-decade, multi-trillion-dollar run of capital that's going to flow into this sector, notwithstanding the short-term hiccups in the venture market and food tech more generally. But we can get into that right now. So the three key verticals that we focus on are cell culture companies, precision fermentation companies, and then the enabling technologies for each of those. The cell culture companies are for the production of cultivated meat and seafood. This is a very exciting technology. And when we made our first investment back in 2018, there wasn't even the regulatory pathway to get these products approved. But today, there are a number of companies with product approvals in Singapore, in the US, and we have it on good authority through the grapevine that there are a number of approvals due to come out shortly in the US, as well as other jurisdictions such as Australia and New Zealand, South Korea, and Japan. This technology is using cell culture. So you take a sample of cells from a living animal, you isolate the stem cells, you provide those cells with the environment that they need to grow along with the nutrients. They experience exponential growth, and then you have a biomass of stem cells. No one wants to eat stem cell burgers. So then the trick is to get those cells to differentiate into muscle cells and fat cells, the specialized cell types, which are the primary constituents of meat. And then you combine them in the relevant ratio to give you the lean or the fatty cut that you might want. Precision fermentation, the second vertical. This is a very exciting technology, but it is also a relatively old technology. This is where you take a microbe, could be a yeast, E. coli, another type of fungus. You genetically modify that. You insert the code for the protein that you want it to produce. You feed it sugars in a fermentation tank in a process that is not dissimilar to brewing beer. And then that organism expresses the protein inside its body, and then it might secrete it, or you have to crack open the organism and pull that protein out. And then you end up with large quantities of one specific protein. This was first commercialized back in 1978. This is the same way that insulin for type 2 diabetics has been produced since then. And there have been numerous other examples where a product like insulin was previously derived from animals, but is now provided exclusively by this technology. But what has happened over the course of the last few decades is that the cost of genetically modifying those organisms has come down several orders of magnitude. So you can now apply this very well-established technology to lower value proteins. So turning the equation on its head of relatively low volume, ultra high value human therapeutics to low value proteins like dairy and eggs, but those are required in absolutely huge quantities. Then finally, the enabling technologies. Our key play here is actually in the physical infrastructure that is going to be required in order to scale precision fermentation companies. I'll show you some pictures later of the factory that we're building in Indiana. This, we believe, is one of the best ways in order for us to generate true cash flow from our portfolio companies, which I will get to in a little while. I've told you about the cell culture. Here are some depictions of the process for precision fermentation as well. So why pursue cellular agriculture in the first place? The key reason is because we simply cannot feed today's population with current consumption patterns and production methods, let alone the additional 2 or so billion people that are going to be on the planet by 2060. There literally isn't enough land to grow enough feed to animals in intensive farms. And we contend that this is the only technology that has the potential not just to increase food production, but to actually decrease the resources that are required to increase that production. So it is very, very exciting. But the reality is, if this doesn't work, we've got a whole bag of other issues to deal with. And it possibly may not be even worth pursuing other technologies to fix things like our current energy production. The use of animals to produce our protein is extremely resource intensive. Industrial animal agriculture accounts for anywhere between 18 and 25% of greenhouse gas emissions. The list goes on of pretty scary statistics surrounding the use of animals. 50% of all fresh water that humans use goes into animal husbandry. 70% of all the crops that we grow are not for direct human consumption. They get fed to animals in intensive farms in a very, very inefficient cycle. And for example, a chicken has a 9-to-1 calorie conversion ratio. A cow has a 25 to 1 calorie conversion ratio. And the latest research from CE Delft indicates that cellular agriculture should have a calorie conversion ratio below 2 to 1. So you're more than an order of magnitude improvement on the calorie conversion ratio compared with cows. There are increasing concerns around animal welfare. 80 billion animals, 2 trillion fish are slaughtered every year. We think that this is a much more humane way of producing our protein. But at the same time, the food system is so vast. We have so many animals that this technology is not a threat to farmers. It is going to take multiple decades before we start truly displacing conventional animal husbandry. What we're talking about right at the moment is building additional plants that will supplement the current growth rates in production. And ultimately, just like with the energy transition, we will begin to displace fossil fuels. Here, we will begin to displace the use of animals. Those animals that are currently intensively farmed, including the fish farms, consume about 80% of all antibiotics which are produced, which are medically important for humans. And this is a major driver of antimicrobial resistance and superbugs. So look, there's many, many reasons that we want to pursue this technology, and there's no good reasons to block it, notwithstanding there have been some pretty negative headlines, which I will also address shortly. Here you see a couple of environmental credentials of conventionally farmed beef versus the plant-based meats, and then the life cycle analysis of cultivated beef. Clear improvements across the board for greenhouse gas emissions, land use, and water. And even though this industry, animal husbandry, is not energy intensive in the first place, you still see a pretty dramatic, circa 50% improvement in energy use. These are absolutely massive markets, multi-trillion dollars combined. You've got beef, pork, and poultry over $1 trillion, dairy at 900 billion, eggs. Actually, that egg number needs to be updated. It's more like $300 or $400 billion, but very, very large markets that have not been disrupted for a very long time, and that's because we haven't got got down the path of applying technology. We've been using some elements of genetic modification. A company like Genus that's listed in London does genetic modification for pigs, but they're talking about a 1% improvement year on year, which is just not fast enough given the very serious situation that the world finds itself in from a sustainability perspective. Here are some of the products that our portfolio companies are producing. I've had the opportunity to try the bluefin tuna. I've had chicken from 2 different companies. I've had lamb. I've had pork from 2 different companies. I had some bacon from Uncommon the other day. I've had the dairy proteins. I've had the egg proteins. And I can tell you that these proteins have the same sensory profile as the conventional products, and that is what is so remarkable about this. I should clarify that we did not participate in the plant-based alternatives, and one of the key reasons, in fact, the key reason that we didn't, is because the sensory profile simply wasn't good enough. The only research that I needed to do in order to avoid the plant-based hype cycle, which has unfortunately turned into a disaster and read across for our portfolio companies and for Agronomics share price, I just needed to try the products, and you cannot convince me that those products are good enough, or were good enough to get repeat purchases. And unfortunately for those plant-based companies, that has turned out to be true. Now, there has been very consistent positive momentum in this industry since we started deploying capital in 2018, from regulatory regimes to governments investing money to very significant sums being raised in the industry. But unfortunately, this has been overshadowed by a lot of the negative press. And here are some of the headlines that have come out from very substantial publications. And if this was the only slide that you were to read, you would think that that all the major publications were completely against this industry. But I'd like to give you a little bit of color on some of these. I think the first thing that I'd like to point out is that the New York Times, Wired Magazine, and Bloomberg, 3 major publications, which pushed out very, very negative headlines. These were all written by the one journalist, freelance journalist, a guy called Joe Fassler. He clearly has it in for this industry. I don't know why. I have actually met the guy in New York some time ago, but he wrote basically the same thing 3 times. No new information in each article, but unquestionably that has caused significant damage. Now, the other thing about what he wrote is that essentially all of the negative attention was focused on 1, maybe 2 companies. The first is Upside Foods, which by all accounts is a credible company. The second, which has really damaged the entire industry, is a company called Good Meat. And it was, until these articles came out, an open secret that this company was no good. Back in 2018, and all the way through 2021, when the market was hot, we were being offered shares, secondary shares in that company by a number of different counterparties, all at massive discounts. The writing was on the wall. We knew the technology wasn't brilliant, but unfortunately that has tarnished the entire industry because it has raised so much money, $1.26 billion out of $3.5 billion raised by cultivated meat companies in total. And similarly, $600 million has gone into Upside, which is one of the reasons that it captured so much attention as well. Worth pointing out, the Perfect Day on the precision fermentation side also, particularly more recently, has attracted negative headlines over its lack of desire to fulfill its side of the contract with its contract manufacturing partner. But so $7 billion in total has been invested in this industry, 3.5 into cultivated meat, 3.5 into precision fermentation. But that is up from just $50 million in 2018 when we started investing. And if you look at the concentration of the largest companies, you can see that it's still relatively slim pickings for the companies lower down. But I'm pleased to be able to tell you that a number of companies within Agronomics portfolio have raised very material amounts even in the last few months, and that includes Blue Nalu and Mosa meat, and we're actually going to talk about that in a little bit. So the first wave of products have already been approved. These are actually on the precision fermentation side. But what this shows is that regulators are opening up. I've already mentioned that I think the next jurisdictions which are likely to open the doors to these products are Australia, South Korea, and Japan. But the thing is that we don't need additional jurisdictions at this point. The technology is still only at a stage where we can't feed 10,000 people with it, let alone 1 million people. Now, we are getting there, but in this capital-constrained world, it is more and more difficult for these companies to go out and raise 100, 150, maybe even $200 million for their first of a kind facility. But what is very exciting is that contract manufacturing is coming online in the next couple of years. So here is our portfolio. It covers all the major protein categories. We have beef, pork, chicken, seafood, dairy, eggs. We even have exposure to palm oil, a company that's producing hydrogen using fermentation. And then we have a pet food company called Meatly, a cultivated chicken. But even at the bottom end of our portfolio, small and modest investments in plant cell culture companies that are producing coffee, cocoa, and cotton. So you can produce almost anything, any organic molecule with these technologies. And again, we think that the applications of biomanufacturing more broadly are only just getting going. McKinsey put out a report about 6 months ago indicating that as up to 60% of all physical inputs to today's supply chains could in fact be produced through biomanufacturing. And we've got the portfolio to play to that theme. We have about 11.4 million pounds of cash left. This puts us in a strong position to keep the business going. But as I said at the beginning, we have essentially deployed all our capital. So this is the portfolio that investors get. We will simply not be raising additional capital while we trade at such a material discount to our net asset value. We have raised 135 million pounds to date, mentioned. Our net assets are about 170 million pounds. So we have actually made money on paper, but unfortunately our market cap today sits at around 80 million pounds. This is, again, very unfortunately a reflection of the London Stock Exchange and the conditions that persist in the UK stock market. You may have read some headlines around various brokers writing to government ministers asking for changes in rules. But unfortunately, our peer group are all trading approximately in line with us, anywhere between 40 and 70% discounts to NAV. I'm not aware of a single investment company or investment trust that is trading at par or let alone a premium. You can see the bulk of our capital sits in Series A and Series B investments. So although these companies are progressing very quickly, they are still, for the most part, pre-revenue. We've got good exposure across the US, Europe, a little bit of exposure in the Middle East. And we've also got a pretty good diversified portfolio across fermentation, cell culture, and infrastructure. We do have a tiny bit of plant-based exposure there. I will not go through any of these case studies, with the exception of Liberation Labs, because I haven't spoken much about the infrastructure. But this is a company that we started from scratch. We were speaking with all our portfolio companies in the field of precision fermentation side, and as well as companies outside of our portfolio. And the one thing that became clear to us is that even when these companies are able to genetically modify their organism, develop a bioprocess that is highly efficient, and organisms that are very efficient at converting the feedstock into the final desired protein, there simply isn't enough physical capacity to brew proteins that would produce anything like a meaningful amount of protein in the context of the food supply chain. So Liberation Labs is building the first facility, which is dedicated to food production. It's a 600,000 litre fermentation facility for 150,000 litre tanks. This is adding about 1% to global capacity of 60 million litres. But what is most important is the location of this factory. It is in North America, in the state of Indiana. Most of the 60 million litres of fermentation capacity today is in Europe. Most of that is 40 to 60 years old and originally built for pharmaceuticals. So the facilities are not food grade. Even their drainage systems are not done to a specification that would make them suitable or easily refurbished to be able to host food production. This factory costs $115 million. It will throw off about $25 million of free cash flow once it is commissioned in Q1 of 2025. And we are about halfway through the build program. So it's very, very exciting to see a company that's so far advanced, so close to not just generating revenues, but actually generating cash. And by the time this thing is fully financed and up and running, Agronomics is going to own a third of this business. And that, we believe, is going to be a very substantial event for Agronomics. So keep your eye out for the announcement around the financing of Liberation Labs. Here's a 3D rendering of the image, the factory. You can see the size of these spray dryers and fermenters. These are very heavy. That fermentation tank there, if you can see my mouse on, or anyway, in the top right, that thing weighs 50 tons. The first one was delivered about 6 weeks ago. The second one was delivered about a week ago. So they're going up very, very quickly. And like I said, this will be commissioned around Q1 2025. There's a good image of just how tall it is. That is a very substantial crane. So I'll finish up here. This is the only way that you can get exposure to cellular agriculture. We have a major year ahead for our portfolio companies with a number of financings and as well as product approvals likely to come through. This is supported by secular trends that are not going away for decades. And really, this is the beginning of a multi-decade, multi-trillion-dollar run of capital into this sector. Thanks for listening.
Thank you very much, Anthony. We've got a few questions that have come through. The one that echoes one that I had is how would you best describe yourself? Are you an investment company? Are you a holding company, a hedge fund, an ETF wrapper like Cathie Wood's Ark, or what?
We are very technically, we're a Rule 8 investment company on AIM. But for all intents and purposes, you can consider us a listed venture fund. We don't have controlling positions in any of our portfolio companies. We do have board representation. I sit on the board of 8 companies. Jim Mellon, my co-founder, sits on the board of 3 or 4. So we do participate very actively in these companies, but not a holding company, an investment company.
Cool, thank you. And there's a couple of questions in a sort of similar theme, which I think you've addressed. Talked about 11.4 million in capital. You've also talked about 10 years of runway, and so can you just explain?
Yes, well, actually,
some of these companies have ongoing liquidity requirements.
Right, for sure. Our underlying portfolio companies are going to need to raise additional capital. But in venture investments, you typically only deploy funds across 1 or 2 funding rounds. And that is because hopefully by the time you're onto your 3rd funding round, the valuation of the company has gone up so substantially that adding an extra couple of $1 million to that position is unlikely to make a material difference to the final outcome of your investment. So, there's a very broad range of companies in terms of cash runway. Some that have just raised, have 2 years of runway. Others are, raising money at the moment. And for sure, it's challenging in this market. But it's worth pointing out that within Agronomics portfolio, across Series A and Series B financings, in cellular agriculture, we have had the 1st, 2nd, 3rd, and 4th largest financings within our portfolio. And actually, in the next couple of months, I certainly hope that it will be the fifth and sixth. So I really think that speaks to the quality of the companies that we've invested in. Only good companies are getting financed in this really still very challenging environment.
Okay, and what portion of that 11.4 million do you see as being committed?
None of it. 11.4 from here is essentially to keep the lights on. Agronomics operating expenses are only about £1 million per year. And of course, £11.4 million with interest rates where they are actually generates quite a bit of cash. So we simply, to address Bart's question, we are not going to raise money at a discount to NAV. It would be highly dilutive and would not be the right thing for investors. And so we simply will not do it. Yes, that will mean that in a number of cases, our stakes are likely to be diluted. But again, this is the way that the venture market typically functions.
Thank you very much. And when are you expecting to be cash flow neutral?
At the Agronomics level, Liberation Labs will generate $25 million of cash flow. Agronomics will own a third of that. That will obviously more than offset any operating costs that Agronomics has.
Super. There's a question about halal and kosher relevance of your products, particularly, I guess, the meat products. Can you talk to that?
Yes. So Supermeat, our Israeli chicken company, has received OU kosher certification. I'm not a religious scholar, but I understand that to be the highest threshold of kosher certification that is out there. There have been a few other companies that have received slightly lesser certifications. Aleph Farms, also based in Israel, received some form of certification, but not the OU certification. So that's pretty exciting for Muslims and Jews.
Thank you. And there's a couple of questions on alternative capital sources, specifically private markets and NASDAQ. But presumably you're a little bit hobbled by the existing price to NAV in that it's going to be unlikely that you find a market pricing you differently whilst that sits there.
I think so. I mean, in terms of looking at alternative stock exchanges, I did do back in 2022. I did a little bit of marketing in the US. By that time, the markets had already turned, and clearly the tailwinds of the boom cycle had faded. The reality is that the investment company structure is not something that US investors are familiar with nor comfortable with. And so everyone, it would of course be fair to say that the US has the largest, deepest capital markets of any country, but for our specific structure, I don't believe that is a silver bullet at all.
Thank you. And question as to whether or not any of your companies has recently done a down round, or if one is likely in the near future.
Yeah, look, not just yet. We do have a couple of companies that haven't performed. That is, of course, typical for venture portfolios. Typically, a venture portfolio would be defined by 1 to maybe 3 winners. And at this point in time, I think we've got plenty more genuine shots on goal for some serious wins. But we have had, or we are on the cusp of a couple of markdowns. I should note, we actually did write down 3 companies in full back in, over the last couple of years. One of them was Ohio, the other was New Age Meats, and then Shiok Meats. Shiok Meats recently, even though we wrote it down in full, recently got sold, and we managed to write that back up, and at least on paper, recover some value there. But we'll see in time. Some of these companies definitely need to raise soon.
Thank you. And the remaining questions are really on the same vein, talking about discount to NAV. And one is whether there is a possibility of a takeover. Another is why no share buyback by the company in the recent window.
Yep.
And another one asking you to get out your crystal ball and decide and define what is the catalyst that might move the discounts, which are a fairly market-wide phenomenon.
So in terms of the discount and when that might narrow, obviously a little bit of stabilization of various geopolitical flashpoints would help. Interest rates trending back down would help. Look, it will just take time. Unfortunately, a number of the institutional investors that we brought in 2021 have suffered massive redemptions. And as a result, they are forced sellers. They have to slice the pyramid. Agronomics is relatively liquid compared to a number of stocks with its assets or market cap. And as a result, those fund managers have to just sell whatever they can. And I'm sure that has worked against us to some extent. In terms of what is likely to change our fortunes, I mean, I had certainly hoped that seeing our portfolio companies raise very large amounts of money, Onego $40 million, Lunalu $33 million, Meatable 30 million euros, Mosa Meat 40 million euros, right? All of these have happened within the last 6 months or so. And I think Formo and Liberation Labs are also going to raise money, sums that probably above that. But I think really in this environment, what investors want to see is cash flow. And so I think that if there is one thing that you force me to pick, that it would probably be the financing of Liberation Labs, which means that the factory can get built. And there is no doubt in my mind that factory will be at full capacity from the moment it is commissioned, because there is such a significant bottleneck in fermentation capacity globally. There's this wave of companies coming through with nowhere to produce. A lot of customers in discussions. So sort of stay tuned for that. In terms of the why there wasn't a buyback, I know that this has been a source of great frustration for retail investors and perhaps institutional investors as well. The reality is that at the point that we announced that buyback, we have, or the directors have been in possession of price-sensitive information for the entire period, and as a result, the company has been in a closed period. So they were not able to act on that.
Yeah, I mean, you've also always got the issue that you're a permanent capital vehicle, and buybacks dilute some of the benefits of that permanent capital. And I can understand the attraction to an investor of seeing a buyback that narrow a discount, but it's they're definitely two-edged swords.
Yeah, look, I mean, of course we want the share price higher, but at the same time, even even a substantial buyback is very unlikely to get us to the point that we're trading at par. And that's kind of the only thing that matters. If we were trading at par, then we could raise additional funds. As we're not going to. So fully accept that it's painful and frustrating. But we believe that in time, the fundamentals will prevail and our shares will trade higher.
And there's the takeover question left, but there's another sort of element to the capital management, which is the possibility of asset sales. And there must
right.
be PE companies out there that would take a look at some of these assets at valuations.
Yeah, look, we're edging closer to some of our portfolio companies, but they're not ready. They are still venture companies, and it's going to take time. But like I keep saying, Liberation Labs is going to be generating cash, and a lot of it's the largest position. That's not an accident. That's by design. It's because it's a classic picks and shovels play. This is not a sort of bet on any individual technology working. This is a broad-based exposure to the entire field. And if one company or one client of Liberation Labs doesn't work out, then there are many behind that can fill that capacity. is there a possibility that we might be taken over by a bigger investor at this discount? Look, Jim owns 15% of the company. The liquidity, although good from a retail investor perspective, probably doesn't facilitate, at least without a substantial increase in share price, a larger institutional investor taking a position that would allow it to squeeze all other investors out and take over the company. So I don't think that is a realistic possibility.
Thank you. And could I just ask you to run a little bit over the genesis of the company, how it came to be, because it's got a left field strategy. I'm quite interested to hear that.
Yeah, absolutely. So Jim Mellon, my co-founder, that many of you might be familiar with, he's a prolific investor. He has made his money over the years by identifying emerging investment themes before they become mainstream. And he's really done this very successfully. A couple of the themes that he's covered are everything from emerging markets, natural resources, the credit crunch, biotech. But I was working on. I've been working with Jim for nearly 17 years. Prior to this, I was doing a lot of work, and I was the key researcher for the book Juvenescence, which Jim wrote. That was on the field of longevity, the aging research, slowing, stopping, or reversing aging in humans. And while he was busy working on that, he came up with this next theme, which was alternative proteins more broadly. So when we set up Agronomics, we went out and raised a little bit of money. We looked at the entire field, but quickly narrowed down the focus into the companies that were using biotech to produce food rather than the plant-based alternatives, because we didn't think those products were good enough, nor did they have any meaningful intellectual property protection. So although it takes longer to get these cellular agriculture products approved and onto the market, once you get them approved, they are much better from an investor's perspective. At least that's the thesis. So I take absolutely no credit for coming up with the thematic. That was all Jim. But we have very successfully got out and raised quite a lot of money, established Agronomics as one of the, if not the most active investor in the world in this very narrow field. This is how we got here.
Fantastic. I'm looking at the board for any more questions. I'm not seeing any at the moment. So is there anything else that you would like to say to this audience? I mean, you're clearly, we're always pleased to see companies that don't need to raise capital talking to individual investors and keeping the iron in the fire, but also looking to manage the discount through knowledge and transparency. And that all of that is excellent. But is there anything else you'd like to tell this audience?
Look, just to say thank you for those people who are already supporters. And hopefully we'll see a material change in the near future. Thanks for your time.
Fantastic. Best of luck with it, Anthony, and thank you very much for presenting.